Hey everybody, welcome back to our weekly podcast. My name is Patrick Tan, General Counsel for ChainArgos. With me, as usual, every week, Jonathan Reiter, our CEO and Chief Data Scientist. Thank you for joining us. Thank you for all the comments, likes, and subscribes. We've got a big show for you today. It's an all legal episode, I guess you can call it that. We're going to be speaking about a bunch of lawsuits that have been coming out over the last couple of weeks. Spoiler, I think the government might have finally figured it out. So, let's just unpeel this layer by layer. Today, we're going to be talking about, this week, we're going to be speaking about Silvergate Bank and some of the fines and sanctions and issues which even some of their top executives are facing in the aftermath of that collapse. And John's got some interesting quotes for you guys, although I don't know if the documentation is up, but we'll find it. Next, we'll talk about the Canna SPAC. Am I saying that correct?
I think so. It's supposed to be a cannabis acquisition company, so there you go.
Yeah, so that makes sense. It's the Canna SPAC. Apparently fake or shares which were not authorized to be issued were actually issued. And the question we're going to ask is, does DeFi actually fix this? Is blockchain technology necessarily useful for this sort of things?
Or automation
in
at all.
general, yeah. Finally, we're going to speak about the Consensys lawsuit. This is the SEC's claim against Consensys, and the complaint is perhaps not like anything that we've seen before, which seems to suggest that the powers that be, such as it is, are starting to understand how this stuff works and are kind of methodically kind of going through this bit by bit and taking things down, which is, I think, for most people should be disconcerting to say the least, because if this is where they're starting at, it is only going to get worse from here. But
that's the theme both for Silvergate and for the Consensys one, where things that never made any sense, we'll get to, I guess, now it sort of starts to make sense, and the answer is not that the government, that you found a loophole. The answer is you just ignored clearly written rules.
Yeah, one of the things that struck me about reading this thing was that, sometimes you look at these things, especially if you've been in law and finance as long as John and I have, and you wonder how these people, maybe we're the stupid ones, maybe we're the ones who are overreacting, and all this is certainly fine. And then you start to look at some of the governments, and then nothing gets done, and you think, oh, okay, maybe we are wrong. And then you start to look at these, and you go like, no, they just took it just took a while. That's all it meant. So let's talk about Silvergate Bank right off the bat. Unfortunately, I lost that quote, but it's something about lumps.
Yeah. So Silvergate Bank, somewhat famously and very loudly, was shut down in March of 2023. This was a few months after the FTX explosion and a number of other issues surfaced, and Silvergate had been operating along with Signature Bank. The two of them at the same time sort of exploded and shut down. Similar, not identical situations. They were operating gigantic internal payment networks, servicing pretty much entirely crypto exchanges and trading firms and those sorts of folks, doing crazy large volumes out of quite small banks, and nobody really understood exactly what was going on or how it was legal or okay, whatever it is. So Silvergate Bank was what had been a very small bank, moved into banking, blockchain, whatever companies, and they set up this thing called the Silvergate Exchange Network. That was an internal payment system. It was doing on the order of $1 trillion a year in volume, internal payments, sort of to give some scale. So this is US dollar payments, right? So the global economy, the total amount of value being sent around, not financial transactions, but economic value, annually is on the order of 100 trillion. So that's 1% of global GDP. Similarly, Fedwire, the U.S. wholesale interbank payment system, does about I think it's $1 quadrillion a year in payments. So these guys were 10 basis points of the total U.S. banking system local payment volume, which is pretty large. The settlements were, they were doing a big amount, right? To be on the order of 10 basis points, a percent, whatever, of the total dollar settlement system is a lot for a bank with a balance sheet of, it was on the order of $10 billion. It was 13 or so billion balance sheet, 15, whatever, the largest. So we now know, I'll just read you a quote here from the court filings, the charges. So this is, I forget which, the COO or the CFO, the person responsible for compliance stuff and financial transaction monitoring, they were told that, quote, internal transfers are not a transaction type that can be utilized in building a risk model. So what that means is their software monitoring the Silvergate Exchange network treated all the payments as internal payments. So Silvergate Bank paying Silvergate Bank, which is not a risky thing. You paying yourself. There's no KYC issues. It's an internal record-keeping thing. And so they didn't have that in their risk model. And the response from that person's supervisor, who I believe was the CFO or something like that, was a, quote, we have known of this issue and either we have established other controls to account for it or we haven't, and we have to take our lumps. And the lumps are now being administered in the form of, I believe in total they want a $50 million fine and a number of other things, barring people from various industries for a while. That's the aggregate amount, but they're personally charging a bunch of the senior management of this place. So they had a system that was designed to do some kind of transaction monitoring, and the counterparties on the Silvergate Exchange network fed to that system as internal transfers, no AML risk there, and they were unable to. Well, they launched it without that working properly, and it seems to have taken them a very long time. There's a later quote, I think I finally got the system to build some monitoring rules for SEN. All they needed to do was substitute the account owner's name for internal transfer. I don't mean to suggest that's a 15-minute job because it's software and it's complicated, and I'm sure there was a vendor, whatever. But, taking over a year to do that when it's a core responsibility is not great, particularly when it leads to your company being shut down and you being fined personally. As Patrick alluded to earlier, here it never really made any sense how these payment networks were okay because, of course, the volumes and the circular nature of a lot of the payments suggested AML problems, the types of things that if you did between banks, so my account to his account, back and forth in loops, questions would be asked, and nobody understood how that was okay, and it turns out the bank knew and has stated in writing that it knew that it wasn't surveilling them at all, and that's how it happened. And as soon as the regulators, who again, the document includes references, the regulators repeatedly told them they needed to fix this, and they, I guess the short answer is didn't until they got shut down. So now we understand what was happening inside Silvergate, which went down without inflicting losses on people. It had no leverage. It did very little lending, whatever. One imagines that the procedures inside Signature were at least as bad, if not worse. The way these things have looked so far, these guys probably use the same external vendor. I wouldn't be surprised to find out that it's the exact same piece of software that was configured in the exact same wrong and apparently illegal way. And there you go. So we're learning more and more about this stuff. I will note, for the record, that at every bank I've ever worked, the largest counterparty is always, internal transfer, someone in operations fix it later. But I don't work in the payments part, and it got fixed later. I just booked it against, customer not set up yet, whatever, transfer, legal entity, wash trade, whatever it is. Someone did resolve it, and then it went through the proper procedures, and there were similarly procedures for checking that too many trades didn't sit in the internal transfer no monitoring account. That's just a way to ram stuff in the system so the risk can be managed. And AML risk isn't a minute-to-minute thing, whereas market price risk is. Yeah, so there you go. They're getting fined. They've settled, right? I don't know whether there will be criminal charges in the future, but I'd imagine these people are providing all the information they can about their investors and customers and whatnot because
that's how you stay out of prison.
Yeah, the situation is not good, right? We knew our system didn't do AML compliance surveillance properly for a year, and we processed, a few percent of GDP in payments among a small number of companies, many of which were offshore companies with unclear ownership, and, maybe we don't want to get in the maximum amount of trouble for that.
Okay, so, not much to say about that, except that.
Well, and you'll note that essentially no bank is running one of these networks anymore.
Yes.
And it appears that the real innovation was finding a way to build a payment system that was incompatible with the standard vendor systems for AML surveillance. That was the change here. I'm sure Tacit Pay and the other systems, the integrations, were intentionally or otherwise designed to evade the application of the external vendor systems these people all use to do transaction surveillance. That was the accidental innovation.
And the other thing is that because these banks collapsed, and then they had to go into what is that term? I
It was a
forget.
receivership.
Receivership.
Well,
That's
they,
right.
yeah, sort of.
Well,
Silvergate just voluntarily wound down, but whatever.
and then when the government had to step in, it meant that they could see everything, and they could see every single thing that had happened up to that point.
This was known by the banking regulators. Some of their quotes in this thing about the banking regulators telling them, "You've told us your system's inadequate. Have you fixed it? Not yet." You know,
Yeah.
stuff like that was going back and forth. It wasn't secret to the government. They don't come in on your first violation and shut you down.
Yeah, but the interesting thing is, of course, a lot of the counterparties, a lot of these crypto companies, Web3 companies, who had bank accounts at Silvergate, who had bank accounts at Signature, and to a lesser extent at Silicon Valley Bank, all of this stuff, all these chickens are going to come home to roost in the weeks and months to follow, because just looking at the some of these lawsuits, you can see that there is a commonality in the thread that's running through them, which if you looked at each of them in isolation, and also if you compare them to, like, say 6 months ago to some of the SEC actions, there has been an incredible advancement. It feels like there's been a leap in terms of understanding and knowledge of how these things work. So I'm wondering what's going to happen next. So switching gears a little bit, let's talk about the Canna SPAC. TLDR, a SPAC is basically one of those, it's not a public listing, it's not an IPO, it's sort of like a shortcut process through which you have a public listing of shares. And they all, I think it's $10? Is that
the U.S. style one. So very quickly, a SPAC is a structure where you go out, you raise a bunch of money, and say, I'm going to use this money to go buy a company.
Yep.
Right? And then you go find a company, and you buy it with some of that money, and oftentimes somebody else lends you money, gives you more equity, whatever, to buy it. So you have a listed company that trades at some nominal share price that is the amount of dollars that went in, and if you don't find a deal for a certain period of time, you return the money plus interest, you shut down. So in different countries, the convention for the share price is different. In the U.S., it's normally $10. It doesn't have to be. So this was actually a Canadian whatever SPAC. Matter. So what happened here is, because of the way that structure is set up, all the documents for these structures don't allow the issuance of additional shares that aren't paid for in cash at the same price. Because let's say I raise $1 million this way, all my shareholders have to get back their $1 million plus interest if I don't find an acquisition target and I liquidate 3 years, 5 years, whatever it is. I can't go giving out shares for free to pay for some other service, because that dilutes the cash claim on liquidation. Right, this is a standard problem. Fine. If somebody wants to come in, because sometimes companies will pay for services, particularly younger companies, by issuing equity to them. And if that accretes equity value to the business, or what value to the business, that may be completely fine. But in this case, they can't pay for services with these shares, because if they don't find a deal, that just screws the people who put their money in the first place, on the condition that if they didn't, vote through a merger, they got all their money back. Now here, the company recognized it couldn't issue new shares to pay for something, doesn't matter what, and instead it gave somebody a document promising to issue them shares when they were able to get approval. Right. So if they never closed a deal, these people would never get shares. And if they closed a deal, they were promising after they closed a deal to get approval to issue additional shares and pay them. Fine. There's nothing wrong with any of this so far. So this looks a lot like a SAFT, which was a common thing for crypto projects for a while, and to some extent, people still do future token agreement type documentation. Now, the big argument people make in favor of automating those activities is that the contracts can't be changed, everything can be audited, visible, whatever. In this case, the person who received this SAFT-like document went to the transfer agent for the stock, the company that keeps track of how many shares there are and who owns them, and presented the document and said, we've been given shares. And they agreed incorrectly that this document represented shares and effectively issued them shares and let them sell them in the market. So once they did that, there's no way to undo it, right? Because if there's 100 shares outstanding and now you give these people 5 more, there's 105, they sell them, they trade.
That's that.
They're out there.
Yeah.
Right? Unless you're going to go cancel a random set of trades based on, whose shares you didn't have whatever custody, which is maybe not even possible. Very disruptive. Yeah, so it looks like that was a mistake on the part of the transfer agent, and in fact, the transfer agent issued a public statement saying that in the event of liquidation, they would make good any additional money that was required because of the issuance of these shares. So they're paying the full amount of the mistake in cash out of their coffers there's only a couple companies that do this. Presumably they have some money. It's fine. This is a real back office function in equities. It's not normally in the newspaper like that. So it's a mistake. And I guess this presents us with an interesting empirical question. Again, what you alluded to earlier. There have been plenty of hacks and mistakes and errors in smart contract of various sorts. Maybe not this particular case, maybe this particular case, whatever, this particular style. Here you've got a group that made an error. These errors are extremely rare. Right? So it is a they happen more than zero. I mean, we're looking at one right now. The same company got in trouble in the early 90s for something related. Actually, it was a bond issuance related to some different issues, but exploded savings and loan. And from a little bit of research, it looks like there were a few similar problems around dodgy bond issuance, SPV, mortgage-backed stuff in the early 90s. But this hasn't been a major problem for a long time. So empirically, is this a common enough problem that the smart contract, bug, exploit, programming stuff is a better solution or not? We don't have a clear answer on that, but I guess you could start with a real data point, because it's a bad idea to say we're comparing against a system in which we have no examples of errors. Because a 0% error rate means you don't understand what's happening. Right? So there is an error rate here. It's just very, very low. And the party that made the error immediately said, my bad, I have the money, we're good, we'll fix it. That's a lot better than a smart contract hack where the money's just gone, right? So I don't know. It's interesting to think about. Probably more research needs to be done finding out what the true sort of error rate and loss rate is.
It's also relevant because you see a lot of talk about tokenization of assets, tokenization of bonds, yada, yada, yada. And obviously, this would be a function of that tokenization. If you tokenize stuff, new shares can be issued. Could you do this in an automated way?
Yeah. I mean, is the tokenization reasonable? There was a whole hubbub in the carbon credits market a few months ago when it turned out that a Canadian province was issuing people 2 times the credits that their project was entitled to as an incentive. So my project reclaims whatever, 100 tons, doesn't matter. I would give you 200 tons of credits. And people were saying these are essentially fake. You're devaluing the entire concept of the credits. If you have some kind of transfer agent, somebody running the tokenization machine saying these are eligible for tokenizing, and they make a mistake, you still have this problem. Automation doesn't fix this problem at all. So
it might make it worse.
It might. The more quickly you can turn the crank. And in this case, there was a well-capitalized entity that could be, I'm not even going to say fined. They just put their hand up, and I'm sure there will be a legal settlement with some kind of not very large fine. If you immediately admit your mistake and pay for it, okay-ish. Anyway.
Okay, finally, the Consensys, the SEC suit complaint against Consensys. This one is it fair to say that it's slightly different from every single SEC suit that we've covered on this show?
I think the style of the complaint... Okay, so I guess we'll give the context and then you can give the legal analysis here. So we've spoken a couple times over the last probably 6 weeks. So Consensys complained publicly that they received a Wells notice, so SEC likely upcoming action. But they didn't disclose the Wells notice. They just sort of moaned about how unfair it was and made some indirect comments about how it might have been about certain areas. MetaMask was raised, and we specifically said, if the issue is with the MetaMask browser extension open source software we don't understand, it's got to be something else. The thing that they're moaning about can't be what the government's complaining about. Then Consensys responded, such as it is, by suing the SEC and federal court and asking for a declaratory judgment that ETH wasn't and could never be a security, and that essentially all of their software products could never be declared brokers. And we commented at the time, this strongly suggests that the government's claiming that some part of MetaMask, the ecosystem, as opposed to MetaMask, the browser extension, was a broker. We talked about that a little bit on the podcast, and we now have the specifics of that because the government is alleging, yes, indeed, some things that are MetaMask, the concept, the ecosystem, that are not the browser extension, the smart contracts, the whatever. And yeah, I agree that degree of specificity and that delineation between you have an open source browser extension, but browser extensions are not custodial. Netscape never held anybody's assets in the 90s, right? It's the website and the code behind it that interacts with things. And so it's the back end, and they have a back end, and the back end takes fees. So, please.
So, in this case, the SEC's the main beef, at least from the complaint, is the issue of swaps. And one of the things that is the SEC actually specifically refers to certain smart contracts where the assets are kind of held, not by a third party, but by MetaMask itself in the smart contract. The SEC points out very clearly that it's not the user who has any control over those functions. It's MetaMask.
The user signs a transaction that gives permission to use that asset in XYZ blob of code. And then it goes off through that blob of code, and they can do various things with it. And that blob of code is, in a variety of ways, upgradable, changeable, whatever.
And also not in any control of the user of those things. So it's hard, I think, to say that this is P2P in any way, because there is there's not somebody, it's MetaMask that's intermediating between, and MetaMask is the one who serves you up the best price, as the SEC alleged.
So that's the information intermediation.
Yeah.
So part of the argument is you're providing people with best execution advice and pricing data to help them achieve best execution. That sounds like a core brokerage function. And then, by the way, their money flows through your pipes in a way that is custodial.
So now we can see...
Because it's not a P2P matching service,
no, it's not.
Which would be a separate conversation.
Yeah.
It's definitely a centralized... I mean, there are smart contracts that process huge amounts of money for them. They collect fees. The complaint points out they've received about at least $250 million in fees running this thing.
Yeah.
One simple thing they could do is they could change the fee by upgrading the code and then take most of your money.
I actually liked
this
specific line. Where is it? Basically, the SEC states quite clearly that although the fee is 0 at this point in time...
that's not for swap. That's for
staking.
Sorry.
That's for... Yeah, that's the staking thing. The staking router kind of thing, like to determine which one which specific place use...
They have the same sort of software architecture for swap and for their staking interface.
And so they actually say that even though they don't charge any fees at this point in time, the fact that they don't charge any fees does not detract from the fact that they could charge fees. So you don't actually have to which is, yeah.
I mean, this was my argument against a lot of the supposedly P2P exchanges.
Non-custodial stuff.
Yeah, it was Shapeshift a long time ago.
Yeah.
Shapeshift claiming it was not custodial. Shapeshift was completely centralized and custodial. They just didn't choose to steal your money.
Yeah.
That's not the same thing. There you go.
Although Consensys has programmed its MetaMask staking software so that Consensys can take a fee for each transaction, Consensys currently sets the fee variable at 0. It does not take a fee at this time. Consensys could, however, change the software at any time to assess the fee, in which case the amount of the fee would be diverted from the staking router smart contract into a blockchain address designated by Consensys. And I think that's analogous to the argument that John has been making all the time, which is that, and it's consistent, just because they have chosen not to steal your money doesn't detract from the fact that they could, and therefore the fact that they can means that the whole system is custodial.
There is a little bit of a difference here with something like Uniswap, where there are fee switches, but the code isn't really upgradable, changeable. There's tiny amounts of stuff. The fee rates can be changed in very, very limited amounts. But because there are very narrow ranges placed on all of that, you can argue that the amount of control, flipping the fee switch moves tens of basis points in fee at most from place to place, whereas here, parts of the system are essentially completely upgradable. So you could just switch the fee rate to 100% and keep all the money, right? Uniswap, you can't actually change an existing version of Uniswap through the on-chain governance to make the fee the full amount. You can redirect the fee from one group to another and cause the token price to change, almost certainly. You can impact the price in perhaps trivial, perhaps non-trivial ways. Yeah, here you could just...
You make the fees 100%.
Yeah.
And then that's it. All the money's gone.
Well, you could change the code so it doesn't actually trade. It just takes the money.
Yeah, it just takes you 100% fee. That's how much it costs.
Yeah.
So all your... And you know what? That's something a jury could understand.
But I would also say some of the smart contracts involved there are not even open source. People may not be aware of this. So MetaMask has a whole ecosystem of smart contracts that operate the swap service and their various other services. And some of those smart contracts are not open source, and they process meaningful amounts of value. So I don't know who thinks MetaMask, the ecosystem, is just an open source browser extension, but anyone who thinks that has absolutely no idea how MetaMask works.
This is, as I've said many times after reading this is this is very bad. Not for the SEC. This is very bad, not just for Consensys. This is one of,
This bait and switch exists in many areas. Yes.
yeah, we've seen some SEC lawsuits. The SEC hasn't won all of them. Some of them they've had a bit of pushback. I think if you recall the Ripple one, they sort of won a bit, lost a bit, stuff like that. So people have always thought, oh, okay, the SEC's on the ropes. We've got them. This complaint does not read like that at all.
We've been quite vocal. We think the government's been doing it wrong for years, and this looks like the government's doing it right.
Yes.
I mean, arguing over whether or not some collection of transactions satisfies a given test for being an investment contract
Yes.
is a little bit parochial
Yes.
when the underlying system is completely centralized and custodial, and they just put DeFi all over the website. Maybe go through a different route to resolve these problems.
You look at this, and I mean, granted, it's the SEC. Securities is in the name of the agency, but if you removed the whole argument about securities, clearly these things have value. To me, this is a violation of money transmitter license.
Oh, there's almost certainly money laundering problems here.
Unlicensed money transmitter.
The SEC is not the money laundering enforcer, but they absolutely are. The building must be nearby.
I don't want to say that it would be a open and shut, slam dunk type of case, but because once you take out that whole back and forth about are these securities, does it pass the Howey test, blah blah blah, you get bogged down by that. If you just remove that section altogether, unlicensed money transmitter, that's it. We'll be done by lunch.
It certainly seems like. I mean, many people have pointed out that these systems shouldn't be regulated or don't require much regulation because they're much more secure because everything is user controlled, self custody, and maybe that's true for some part of the ecosystem, but we've been quite vocal for a while. You don't know how the system works, and MetaMask isn't and never has been that. So suggesting MetaMask does not require, MetaMask, the ecosystem, not the browser extension, does not require these types of regulations because it's exempt because of user control. You can only say that if you don't know how the system works, and that's been true for years. Right? Now that everyone is starting to understand how the system works, a lot of these things are going to start to make a lot more sense.
And that's why I'm saying that this, I mean, far be it from me to comment and say that this is a watershed moment, but it looks like
the government seems to be understanding better.
Yeah, it seems as if we've tipped we've rocked the Coke machine back and forth to such a point where we can tip it over now, because this looks like the Coke machine tipping over. I think everybody should read this. It's only 59 pages. It's quite accessible, but you should read it because it does not portend well for a lot of the institutional grand old companies in the Web3 space.
And I wonder how many legal teams only sort of understand the programming related issues that come up here and how custody might in practice work, and how many developers have been disingenuous or embarrassed to not tell the truth to the legal team, or hadn't thought through because software is complex. And sometimes you step back, look at it, and realize, oh no, we actually do have the ability to steal these funds, even though we didn't think we did because of the way we adjusted it. We've seen a few cases where people tried to jury rig solutions to problems in their deployment to make an upgrade or bridge something that ended up giving them complete custody over the money for at least some period of time. Yeah. And that's not good. And I suspect there are developers who didn't realize they did that, people who figured it out afterwards, and lawyers that are not going to be happy when it turns out that they were, if not lied to, at least at best, whatever, accidentally told something false.
And in a way, I mean, you can't expect, the same way lawyers are afraid of math and mathematicians are afraid of, reading
words are not precise.
Yeah. So, you can't blame the attorneys for taking it at face value if a programmer says that this is what it does, the code is what it says it does, and then the attorney not necessarily having the capabilities or the skills required to decipher some of that stuff.
Well, I mean, complex systems are hard. Most reactor meltdown safety incidents have been due to poorly understood interactions in extremely complex systems. These are hard problems. I'm not suggesting they aren't hard problems, but I think you're going to discover a lot of systems are actually more centralized than the people proclaiming they're not. No, or they're just lying.
So the Consensys complaint was filed on June 28th.
The end of last week.
Yeah, so not so long ago, like about almost a week from the time that this is being filmed. Yeah, I don't think people have fully. Well, maybe they have fully digested it because if you look at the and they're dumping the tokens, but yeah, this is not good. Yeah,
Yeah.
ideally this is not good. And finally, we got a comment about FDUSD. I don't think there's anything to say about FDUSD.
I mean, yeah, it's if you spin up your own custodian and claim to have a huge amount of money that you admit you invest in credit instruments of related parties, yeah, good luck with that. Those are not you're falling back to really basic finance issues there.
And on that high note, thank you for watching. Thank you for tuning in. If you're catching us on a podcast where it's audio only, wherever you receive your podcast, thank you for listening. Otherwise, we will see you again next week. Episode 2 of John's podcast together with Dr. Rivera from ICI Bucharest will be out shortly as well with those and well, you catch that the second, we're releasing this in 5 parts, so the second part is also pretty interesting, so you should totally watch that as well. Otherwise, we will see you again next week. Thank you for tuning in and have a great weekend. Happy 4th of July, everybody. I mean, if you're American.
It was yesterday.
Well, yeah, I mean, it's still 4th of July when we're filming this. Happy 4th.